Ladies and gentlemen, welcome. In today's video, we will discuss the IPO of the American food delivery company Doordash. Doordash went public on the 9th of December 2020 at the reference price of $102. The company will close that successful IPO day trading around $189. So the question for this video is whether that reference price was justified by the company fundamentals and determine what is the fair market value of Doordash today. But before going forward, it is important to stress that I am not your financial advisor. This video is for educational purpose only. Your financial advisor is the one to design a portfolio suitable to your psychological and situational profile. For those of you not familiar with my work, welcome to the analyst. What is the fair market value of Doordash? Was Doordash reference price justified by the company fundamentals? For a bit of history and reference, Microsoft went public in 1986 at the reference price of $21. Even after adjusting this price for inflation of say 2%, Microsoft will still be cheaper than Doordash. Another example, Amazon went public in 1997 at the reference price of $18. Even after adjusting this price for inflation, Amazon will still be cheaper than Doordash. So my question is simple. What are the expectations behind the valuation of Doordash today? I will try to give my position regarding the valuation of Doordash. And to make this exercise as structured as possible, I will make the following point. So the question is really about determining what assumptions are supporting this reference price and to test this assumption to see if they are actually realistic. So I will try to determine the reference price of Doordash, what it should have been, and the current market price of Doordash. To do so, first of all, I need to impose a structure that will guide me through the process. And it starts with the following points. The first is obviously that investment is all about profit making, and the company that generates the most value to the investor shall be the most expensive. Now, the second point is that over the long run, return across all sectors of the equity market should be equal. When a sector is the most profitable, investors migrate to that sector till the price appreciation resulting from the migration turn the excess return to zero. And the third point is obviously that we're going to access this value over the short run. So the difference in profit in the short run will obviously lead to difference in valuation. Now, the last, not the least important point is that if we consider the profit making ability as the key determinant of value, to determine the fair market value of a company, we need first to determine its profit making ability by forecasting key metrics, and then use a benchmark regardless of the industry. If we have enough data on how the market price is performance in the past, we assume here that investors are consistent in the way they actually price performance. So The next thing is obviously to determine the investment horizon within which the fair market value or the reference price is going to be tested. So it has been chosen for this exercise to be 9 years. So having determined the investment horizon, we then move to the benchmark. What is the benchmark for this exercise? The benchmark for the exercise has been chosen to be Alphabet Inc., the parent company of Google. We have enough data on this company performance and how the investor have priced the performance of this company. First, we need to adjust the data because Alphabet went public in 2004, and the data from 2004 need to be adjusted considering the inflation rate of 2% to make them comparable with that of Doordash. For instance, the reference price in 2004 was 85. Adjusted by inflation, the reference price is going to be $116 today. So here is the data adjusted. Now what we need to do is to understand the benchmark, to explain the benchmark, to make everyone sort of like move along with us in this exercise. So what we know is that before going public, any company issued like the S1 form. The S1 form is what highlights the past performance of the company, and that guide the investor through the valuation process. The valuation process I meant. So investors were presented with the S1 form of Alphabet Inc. So what they could see is that one, from 2001 to 2003, Alphabet Inc. grew earning per share at a compounded growth rate of 367%. That's what investors know. So based upon their knowledge of the past and the forecast of the future performance, which is known today, investor decided that the reference price for Alphabet Inc. was $85 or $116, which is $85 adjusted for inflation. So what does that mean to us? It means to us that using this benchmark, a given company that we are trying to price will be more expensive if the company can post a performance higher than that of the benchmark. And if the company cannot do that and post a performance lower than that of a benchmark, then the company shall be cheaper than the benchmark. So we know, for instance, using the data that has been posted by Alphabet Inc. that the compounded average growth rate of earning per share starting, for instance, from 2003 is about 82%. Is about 82%. This means that investors using their knowledge of the company past performance from the S1 form and the expectation about the future performance that we know today, investors have decided to price Alphabet Inc. at the reference price of $85 or adjusted for inflation $116. So the next thing that we obviously need to do is to forecast our subject company, which is Doordash key parameters. And here is the key parameters of our subject company. Now, having forecasted the key parameters of our subject company, the next thing that we need to do is first to align the data of our subject company with that of our benchmark. When you take a look at the S1 form of Alphabet Inc., what you can notice is that I think the data start from 1999. Using, for instance, Doordash data, you will see that the data starts from 2018. So if we use 2018 as a reference point, so it is something like 2 years before the IPO. So you need to adjust the data to make them as comparable as possible. So here are the data that have obviously been aligned. So now the next thing that we need to do is obviously to use a comparative analysis combined with price multiple. So the objective here is to determine the price as the combination of the different valuation model that all investors will be using on their own. So there are some investors who consider the price to sell as a very important metric. There are some investors who consider price earning ratio as the very important metric, and there are some investors who consider price to cash flow as a very important metric. So using the comparative analysis, what do we know? We know using the S1 form of Doordash that the company accumulated about minus $20 in earning per share. This is obviously a loss starting from the value of 2018 of minus $67. This is a compounded average growth rate of minus 330%, whereas within the same period Alphabet Inc. posted a compounded average of earning per share of 89.32%. Now, due to the negative value of the performance, the value that we're going to give to DoorDash in the model is 1. So follow me here. Now, we know that the earning per share for the year 2020 was negative, so we cannot use the price earning multiple. So the value that we're going to give to the model is 1. So what does the model do? The model will sanction negative performance, and by sanctioning negative performance, the value that is given to a company is 1 in the model. We're going to show you later how to use it. Now, considering the compounded average growth rate in earning per share over the investment horizon that has been chosen to be 9 years, we know that Alphabet Inc. posted a performance of 82.17% over that horizon, while we expect DoorDash to grow earning per share at a compounded average growth rate of 20.37%, which gave DoorDash a value of 28.92 in the model. Now, we move to the sell. Sales are very important for some investors. So what do we know? We know using the S1 form of Doordash that the company grows sales at the growth rate of 211% starting from 2018, while Alphabet posted sales growth rate of 234% within the same period. This gives DoorDash a value of 105 in the model. Now, using our expectation over the 9-year investment horizon, we expect DoorDash to grow sales at the trend growth rate of 31%. This compared to the trend growth rate of 39.15% within the same period, giving DoorDash a value of 92.39. So now, the next we move to the price to sell multiple that obviously some investor will be using. So the benchmark price to sell multiple is 20.43. Using DoorDash sales per share of 45.88 in 2020, this gives DoorDash a value of 937 in the model. So the next thing that we do is to use the same approach with the cash flow. And with the cash flow and using the same approach, we then move to the determination of the fair market value of the company as the combination of all these partial valuation techniques. So what does that give us? It gives us a reference price of $23.84 for DoorDash. This is the reference price at which the company should have traded. I personally believe that the fair market value of DoorDash is currently about $25.59. This means that DoorDash is not only overvalued, but it's grossly overvalued. I believe that the current market price is a good deal for pre-IPO investor, not post-IPO investor, because I expect the fair market value of DoorDash to trend downward over time. So my question is then, what are the expectations justifying the current market price? What model are you using?
It is important to also address the risk dimension and potentially the different valuation models out there. I am confident using any valuation techniques. So for those using the discount cash flow method, I would like to make you aware of the fact that if you look at the S1 form of DoorDash, if you compare the S1 form of DoorDash with that of Alphabet Inc., for instance, you will notice that DoorDash is still making losses, while Alphabet Inc. within the same IPO period was already a profitable company. What that means is that the discount rate that you should use for DoorDash should be higher than that of Alphabet Inc., because a company making losses has a higher probability of failure. So this means that if you expect the performance of DoorDash to be the same as that of Alphabet Inc. within the investment horizon that we have determined, DoorDash will still be cheaper than Alphabet Inc. So finally, I would like to touch a bit about the approach that I use itself. In general, my benchmark will be a combination of data of many companies to avoid the final result being the influence of the performance of the single company. So if you want to use the same approach, it is important to use the data of many companies, different sector of the equity market, to try to understand how financial market participants actually price the performance of a given company. I really hope you enjoyed the video of today. And if that's the case, do not forget to like and subscribe, and see you next time.